Now, so we touched on regulatory, we touched on commercialization, we touched on cap structure. Now, just because a company is good, and the cap structure may be great, the science may be great, the medicine may be great, the commercialization plan may be great, the regulatory plan may be perfect, have all the right people in all the right places, the capital structure is gorgeous, it still may not be a great stock. Those are things that you see a trading pattern. And these are things that come down to where a stock is a piece of a company and where a stock is a fudge factor in a physics equation. Now, how does the stock market work? Well, the stock market works, there's a certain number of shares out there, and there's a certain number of people that want the shares. And like any other commodity, it meets in a supply and demand curve, and the fudge factor that equates those two lines is called the stock price. You take that stock price, you multiply it by the number of common shares, and that's the quote-unquote value of the company. Now, as an investor, you want the value to go up, but you also want to be able to buy enough in a way that makes a difference, and you also want to be able to sell it. So you have to calculate something that we call the effective float of the stock, and or look for what we call liquidity events. Now, as a small investor, you're not quite as concerned over these things, but you may be concerned over how other people are going to trade it. You want the value of what you own to rise. Values rise in two ways. Either the stock market in the daily trading kind of brings it up because the sum total of the marketplace thinks it's worth more. They vote by buying the shares, or somebody comes along and buys the company, which is a great thing. Depending on what your plans are as an investor or a manager or a board member, individual small investor or a big investor, you need to kind of filter that through your mind. Is this a good stock to own? i.e., where's it going to go? Where's my entrance? Where's my exit? Can I buy enough to make a difference without pulling up the share price myself? i.e., is the market enough? You just look at the daily volume. How much money gets traded in this given stock in a given day? And am I going to be able to get out of it when the time comes without giving away all my gains? Or is this something that I think is so important that I just want to hold it forever? And we love companies like that, where I just think that I don't know exactly where the values can come from, but this is such a unique piece of IP. These people are so good. There's so many different ways to monetize this that, maybe the stock will go up 100-fold. Maybe another company's going to come along and buy this company. Maybe they will just partner it in a way that's so lucrative that amazing amounts of value. Or, they're going to do lots of good stuff, but I don't see where the value is ever going to come. There's just the stock just keeps getting churned. It's all retail shareholders. It's not a lot of investors that the big institutional investors don't own it. There's a art to determining or guessing where a stock is going to go. And this is, kind of the weird public markets part of it. It's you look at, we rarely invest in companies that have hundreds of millions of shares outstanding. Because again, you've got a lot of people who are going to sell the stock. Maybe they held it for a long time, first 10 or 20% rise goes into it, they want to get out. We as investors that typically hold things for years, we don't want a lot of that little buying and selling. We want a whole bunch of other people that all of us own 19.9% of the company, don't have to report. And when the stock goes up, everyone's going to go into their E-Trade accounts and put market orders for 10,000 shares for whatever the price is. Stock is going to double overnight, and then it's going to stay doubled. That's us until someone comes along and Pfizer or Merck buys the company at this huge premium. That's our goal. So you just got to see what the company's going to do. How the trading is going to happen. Is it a good stock? If it's a good company, and then if you decide it's a good stock, it's like, when do you buy it? What's the good timing? And there are timing aspects to it. In biotech, the single most important timing part of it is, when do they need money? Because all of these companies live in, very rarely will you find a biotechnology company that is cash flow positive and self-sufficient. It's the nature of the industry. It's what separates biotechnology from all the other industries in which you can invest, but it's also the reason that the returns in biotechnology, if done skillfully, can be extremely, extremely high. But that involves buying things the right way. If you look at a company and the cash burn is $50 million a year, and they have $25 million in the bank, you know they're going to be out raising money sometime pretty soon because they're going to go broke. They're not going to go broke. They will go out and raise money. They'll come to groups like my group and sell stock, and we will buy stock at a substantial discount to where it's trading now. Now, as individual retail investors, you're usually not going to get a chance to invest at that time. However, you will know that if you look at the balance sheet and you know they're running out of money, don't buy right before all the evidence shows you're going to need to go out and raise money, because the stock will almost certainly take a drop. So similarly, when I tell my students when they interview at biotech companies for a job, it's a very helpful thing to do to walk in and once you've discussed your core competencies in the laboratory and how you see what they're doing and their science, and you talk about the further preclinical and clinical development, you talk about the regulatory strategy, you turn around and you say, as a master's in biotech student, all right, the other thing you need to answer for me is you've got $25 million of cash and near cash assets, and you've got a cash burn of $50 million, not including the phase 3 trials you're going into. How are you going to keep this company going? Yeah, that's a great thing for, first of all, you're going to get their attention, that you know this stuff, but it's the answer they give you is going to be very important. If they say, oh no, we'll just go out and, we'll raise the money, or we'll make do somehow, or we know we have a partnership coming up soon, they've got to give you a credible answer. But you also know as an investor that you don't want to get ahead of that. As a manager, as a board member, this is something you think about all the time. What is your financing strategy? Because you are constantly running out of money. You have to expect anyone who wants to get involved with you as a partner, as an employee, as an investor, as a collaborator, wants to know what your financing strategy is, independent of anything else you do. So no matter where you are in this industry, that has to be something that front and center is something you always think about. It's the cloud that's always there. And you can have an umbrella, and you can have a raincoat, or you can just ignore it, and ultimately you'll get soaked, but you have to have answers to these questions. And the timing issue is a big one. Now, we, for example, will very rarely go out into the open market if a company has less than 18 months of cash on the balance sheet. And when the markets are very hot, the way they've been for the past, going on 2 years now, every company is bulked up. One of the reasons that the market is going to continue to be good for the foreseeable future is that unlike 2008, 2007, 2007 the market was quite good too, but the companies were running their balance sheets much closer. They weren't raising money as quickly. So when 2008 came and Lehman went out and the market just crashed and no one could raise money, we were having a field day just naming our prices. We were investing in companies for less than the cash they had in the bank. So we were buying the assets, buying the IP, buying the know-how, buying the good ideas for less than the cash that they had in the bank. And the companies had nowhere to go. So now the markets have been hot, they've raised tremendous amounts of money. These companies have 2, 3, 4, 5 years of cash in the bank. It's a great place to be. But still, they're still thinking about it. So, in sum, so we talk about this incredibly irrational marketplace, this irrational biotechnology ecosystem, where we take intangible ideas and we take them through steps where we create value, but value which we have no logical means by which we can put a real, true, reproducible digital valuation on. And we try to invest in it, and we try to work and create great stuff in it, and we try to make a living out of it and do good out of it, because one of the great things about life science is you're doing good on top of all this. We're not, running casinos and making cigarettes. Is, okay, how do we do that? How do we apply a methodology to it? So, okay, great. If you're in an irrational marketplace, let's bring in a rational methodology to it. You start with your science. You start with the things that you can most test. You take it through a medical filter, the applied science filter, and then you bring it into the marketplace. You put it within the context of a company. Is it a company that's built soundly, both in terms of the people that are doing what they should be doing, a time frame for development that can be financed, and a capital structure that's not going to scare away future investors. And we know that that company's in a marketplace. Is that translated into a stock that whether or not we want to invest in it, others will want to invest in it in order to support it and let the good work that's being done, whether by us or our surrogates, to continue on. And it's a good thing to know how that stock market works. In other words, when people are going to want to buy it and when we are going to be most able to use the value that we've created to perpetuate the stuff that we've created. And in a nutshell, that's what we do. Questions? Yes, sir.
You said that you look at the company's team members and who they're planning on bringing on board. How deep and down do you have to go? Are we looking for instance, marketing and sales and everything way down the line, or potential, or is that like
inconsequential? It's a very, very, very good question. And it's kind of a four-dimensional matrix. A lot of it depends on what we're buying. Because when you invest in a biotechnology company, you're essentially renting the value creation until they need money again. So you are saying, okay, what am I buying now? Where is it going to be? It's, I invest in a bunch of Canadian companies, so they're always talking about skating to where the puck is. I don't know nothing about hockey, but so what you're doing is you're predicting, okay, here's what we're buying now. Here's the assets. The assets may be nothing but IP. It's usually a combination of IP data and a development plan. So, okay, you're going to have 3 years of cash on the balance sheet. So to me, you're going to be raising money a year from now. In the next year, these trials will read out, so I'll have data. We may need an FDA meeting to plan our phase 2. We may need to get an IND through to get a next thing into the clinic. Or maybe we have a regulatory decision coming up, or maybe we're launching something. The question is, do they have the people in place to do what needs to be done during that period? If it's a company that's establishing proof of concept and safety and doing tox studies, mainly phase 1 type stuff, and they're going to be getting into phase 2 or getting into a 1A/2 type trial, and that's what the next raise is going to be for. I don't really care about their commercialization strategy. It can definitely be in the, well, we could go this way, we could go that way. It's 5 years down the road. We also have business development discussions. Vague is fine there. If it's our pivotal data readout is next month, our NDA is going to be submitted 6 months later, and we're going for accelerated approval, then I want to know, is this going to be partnered? How many sales reps you need? If you're doing it in-house, who your chief commercial officer is, how many drugs he or she has launched in this particular space, how many sales reps they want, what's their rollout strategy. I want projections, a whole bit. So a lot of it depends on what it is they're doing. If they're going into phase 2, great. What's the, is it a single dose study? Is it a ascending dose study? Is it a, how well defined a patient population is it? Multiple diseases, several diseases, is it? Are you doing oral and injectable at the same time? I want real granular data. How long do you think, how many studies? Who's your lead investigator? How long is it going to take to enroll? What's the range of time you're thinking? Do you have an interim look, open label, really tight stuff there? If they say, yeah, we're not sure if we're going to hire a CRO or if we're going to bring somebody in, that's unacceptable. So it really depends on what it is you're buying. What are you investing in now? And that's also a good bioassay for how good management is. The answers they give you, it's tough to, you get an initial opinion on how good a management is. They all make themselves sound like the second coming of Bill Gates and it's like they're all Herb Levinson. It's like, oh yeah, it's like I'm the greatest manager in the world. If they can't give you a straight answer, it's a good way to lose credibility quickly. Next question. I've touched everything there is. Huh? No, okay. Yes, sir.
Several questions.
Okay.
Can you clarify that? Are you buying the stake pre-IPO or post-IPO or both?
Well, we invest only in public companies. So the earliest time we would be investing would be at the IPO. Yeah, a very, very, very rarely will invest in we'll do like a little bridge financing to take a company to the IPO. But one of our core expertise, like anything else, you got to know what you're good at. And we're good at the weird public markets. That's our advantage, is that we know how to structure things in a way where we can take advantage of the weirdness of the public markets. It's what we've done for 30 years. We started going into the private markets, where we started investing during a venture round. Then suddenly, the people around the table, you don't want to be the sucker at the poker table. You want to be the one with the core competence that says, no, the people are giving out terms, and I can do better than that. You want to keep your mouth shut, listen to what everybody else has to say, and say, listen, if we're going to get this deal done, here are the terms that are going to be done. And no one's, and eventually those are the ones that people gravitate to. So our own strategy involves that. So that one of the ways, it's similar, we talk about the management teams of the life science companies knowing what they're good at and being able to define it and bring in those competencies that they don't have. We as investors have to be very honest with ourselves that, the same way, like on a good day, I can tell you the difference between Microsoft and Dell. Tech is just not my thing. I couldn't tell you what the difference between Bank of America and Goldman Sachs are. So I'm not going to be investing in them. As investors, we have to know what our competence is. So we do not, we're only public.
That kind of differentiates you from the VC, the big stage VC.
Right. Now there are some extremely good VC funds that will do crossover investing. And a lot of them will do it because it used to be 10, 15, 20 years ago, the VCs would buy private companies, they'd go public, and that's where they would exit. They would sell all their stock in the IPO, walk away, and go buy more private companies. What has happened is that the IPO has become just another financing vehicle. It is not usually the exit for the venture capitalists. And actually, one of the things that we look at in many of the IPOs that we invest in is, are the venture capitalists reinvesting? Because that's one more, bioassay. It's like one of the lessons my father gave me. He said, much more important than what people say is what they do. And much more important than what people do is what they do with their money. So if the venture capitalists will turn around and invest again at the price at the IPO, that is often, not always, that is often them signaling that they still think there's value there. And the likelihood is going to go up. Sometimes it's them saving the deal. So, because the company's going to go under, and you try to tease that out. But some of the venture capitalists, some of the very good ones, do cross over, and some of them, because they later get used to working in the public markets, because they continue to own them, they're now comfortable doing some initial purchases. First getting involved in a company in the public markets, and some of the big ones, the OrbiMeds of the world, they have friends in these very big companies. They're very good at that too. We're a little bit smaller. We're pure public.
I'm asking the question because it seems like very small numbers of the biotech eventually ends up in the public market. Do you see there's a lot of self-selection problem there? For example, why is company choose IPO as their exits or not exits? Is their route instead? Most of them, why not be bought by pharma if they have huge synergy? They have their own R&D.
Okay. Well, how many biotech companies are there in the United States?
I don't know.
Approximately 2,000. What percentage of those are public?
Very few, I guess.
Between 300 and 400.
Right.
Yeah. Now,
10%?
I'm sorry.
10%.
Yeah. Depending, the number has gone up over the past year because the quote-unquote IPO window has opened. Now, the reason that a lot of them don't go public is that a lot of biotech, I can ask you another question. It's good to have these metrics in your fingertips, by the way. I'm a big, so those of you who've taken my class, my first lecture is on big numbers. And always have a few numbers handy because it's a good means of just stress testing some of the things that you've been told. And it's also good to get away from the vague and to the more precise. So the average number of employees in biotech, the average company in biotech has 50 employees. So there's 2,000 companies, so approximately 100,000 employees in biotech. Okay? So what does that tell us? That the average number of employees in companies is 50. Now biotechnology includes Amgen. It includes Gilead. Gilead has a market cap of $170 billion. They have thousands of employees. So if the average is 50, you start taking the top 10 out of it, you start getting down an awful lot of companies that have 10, 20, things of that sort. It's only worth being a public company if you need to tap into lots and lots of money all at once. So if you're a small company with 20 employees, first of all, you don't want to spend your time going out and meeting hedge funds to raise tens of millions of dollars. First of all, you can't. If you've got 20 employees, chances are your market cap is, or your valuation, you won't have a market cap if you're not public. Maybe it's $10 million, maybe it's $20 million. You can access $1 million or $2 million fairly easily.